Welcome back to New Money. This evening we're discussing investments. My guest David Shapiro. If you'd like to email, you can send your query to info@anchorcapital.co.za. David, let's just finish off with artificial intelligence. You've told me how it's going to make my life that much easier. Is it going to make your life that much easier?
Oh, I'm absolutely sure. I think, we're being a little flippant about it, but if you're if you're an engineer or if you're a chemist and you're looking for data, and you need data to substantiate tests or whatever it is, I think that's where the biggest gains are going to be made. Where it also helps, you're going to find it coming into Apple, where retailers, for example, will be able to understand the needs of their customers. All of this is going to go through, is going to interrogate data or look at data in a much faster way, where you get your answers almost immediately. So you save costs there's saved costs instead of wasting costs on on ages and ages of looking through data. So the applications are going to be enormous. You can do this now, Bryan. You can give a photograph. You can take a photograph and it'll tell you exactly what it is. Some of the things are incredible.
But David,
anyway.
even if people get this information, they've still then got to understand read and understand, because if you get information on Apple, the results, you've still got to interpret and understand the difference. Anyway, before we get on to emails,
I've got to tell you one thing you can do. And this happened, the Beatles just made a record where they used old records to create this. They got John Lennon to sing. So what I'm trying to do to simply understand, Bryan, we can write a song and we can get Taylor Swift to sing it. In other words, this is where the copyright issue comes in. You can get Taylor Swift, by extracting from all her songs. They can do something where you can get it to sing "Happy Birthday" to your grandson or something like this. So those are where copyright issues come, and there's a whole debate going to take place now at Davos on artificial intelligence in the future.
I want to get onto some of the emails, but I just want to get your views firstly. One, with interest rates.
Yes.
The interest rates picked up a little bit in America in the month of December. I don't know if it's unexpected in December because you had Black Friday and you had all those things happening. But your view on interest rates, when do you still feel that interest rates in America will be cut this year?
Yes, they will, because the economy is slowing down and inflation's coming down. You can have 1,000 different inflation readings. Everyone's different. No matter, each economist's got their own view. But I think what is happening is that there's certainly a fall in inflation, and they're getting closer to their target of 2%, which has been the goal of the Fed. So whether it comes this month or next month, we don't know. But
does it really matter in the investing world?
No.
You don't look at numbers. We're going to give results. Everyone's going to be talking about the results for 2023. But markets don't understand calendars. They don't have a calendar 1st of January.
Agree with you.
But if they do coming down, then your view on then can you see markets being better, higher at the end of 2024?
Oh, absolutely. Because as interest rates come down, it puts more money in the pockets of consumers, and they go out and they don't keep it, and they go out and spend it. They might be a little hesitant at first because they still need to build up their savings, which they've all spent. But when rates come down, it changes the whole complexity of issues. It means that your mortgage rates come down. People haven't been going into the housing market in the US because they'd fixed their rates at very low levels. Rates went up. They said, I'm not going to buy a new house because I've got to renegotiate my mortgage. So, the issues are enormous. But when rates come down, it does generally point to better equity markets.
And your feeling for the rand over the next 12 months?
My view is that if markets do take off and the dollar starts to fall as a result of lower interest rates, I think the rand can improve dramatically. It's got nothing to do with politics. Yes, politics can sway it, can have some influence, but by and large, the rand can easily be 17.50 or even towards 70. And I'm talking apolitically, assuming nothing dramatic happens in politics here. They're very, very easy for that.
Well, there are a lot of elections coming up in 2024. That for the moment. People don't always realize that even though everything's coming down. On a daily basis, the news of the day can have an impact on, as I said in my slide originally, it's sentiment, not the fundamentals that necessarily drive the market. And then, David, local markets, you said you can see maybe some of the stocks they're picking up.
I think we'll pick up. Our biggest problem is the commodity markets, and that's driven by China. Yes, there's a lot around electric vehicles and the demand for copper and the demands for elements that go into the batteries. But that's hard to read. It's very, very difficult because I think there's also, commodities are almost impossible to get right. But from our point of view, a lot will be driven by platinum. And platinum hasn't been doing what we wanted to do. The palladium prices come down, rhodium price, and that's also associated with the move to electric vehicles away from internal combustion engines, the ones that we drive. So that's a big problem. And if you've looked at the platinum miners, they're laying off people, their results haven't been good, and that's bad for our fiscus. So, and it's also bad. The other thing is China. China needs to come right. And Naspers Process, which are two bellwether stocks on our market, whether we like it or not, are going to be driven by Tencent. And that's hard to read as well.
Dave, we've got earnings season starting in the next few days. I mean, they've already started. We'll get the text later this month. And your feeling, because remember, now the interest rate hikes are definitely in the results of these companies. So what are it's all about the analysts' expectations versus the performance that has effect. If the analysts say, we expected earnings of the X, and it's X minus, the share comes down.
It's so hard to read, and analysts are all over the place. What we're going to watch for is the spend on artificial intelligence. In other words, how much companies are spending in order to prepare themselves for artificial intelligence. So I'm going to look at the chip companies, NVIDIA, those kind of bellwethers. Also advertising, which comes through in Google, comes through in Amazon, comes through in Microsoft, comes through in all those companies. How much the media is spending. So the tech results are going to be very important, whether there's a change of trend, whether we can find something discernible about the spend on artificial intelligence on this whole thing. The other areas to watch are pharmaceuticals as well. The big theme this year is going to be on the weight loss.
Obesity,
diabetes, and everything. Don't underestimate it. It's big. So, and also I think generally in pharmaceuticals, I think it's an area to watch as well. So, and the normal, the others that we're talking about.
So I'm going to try and get some emails in. If we could please go to my email from Peter in Hillcrest, if you don't mind. I think you've dealt with all the other emails that Jack asked for, and as well as Rodney, so I won't deal with that. But Peter in Hillcrest says, globally, luxury companies have done exceptionally well. However, recently, Richmond share prices dropped. I'm overweight in a few of these, one being Louis Vuitton. Do you think earnings will fall as pressures put on consumers?
We're watching that carefully because Burberry came out with numbers which were disappointing and pointing towards perhaps a slowdown in spend there. LVMH stands ahead of everybody, but I think, Bryan, it's an important question. I can't give you the answer. My long term, I like the company very well. In the short term, it's going to be a pointer towards whether or not the slowdown has affected them. And China is also a very important aspect of it as well.
You wouldn't sell?
Traveling's coming back. Okay. No, I wouldn't sell. What's happened, traveling's coming back. And we're seeing a lot more people. And that might be also a pointer to where these results come. I can't, for the moment, Louis Vuitton hasn't been performing well, as has Richemont, etc. But it really depends on whether we can see a recovery in the global economy and a recovery in consumer spend, driven to an extent by travelling.
Okay. So I want to get this one in. Rosalind in Westcliff, she says, please could you explain some terminology? I will use Wells Fargo as an example. Revenue declined by 11.1%. Diluted earnings rose to $4.83 compared to $3.27, which is substantial. It's nearly 50%. Which number is good, which number is bad, and what do you read into these numbers? So this, you're trying to see how you think. So earnings down, revenue down, diluted.
Why is it diluted? Diluted earnings to an extent. What you also have to remember, they could be buying back shares. I haven't looked at Wells that important. I like to look I go through line by line, and you have to take company line by line. It's very difficult to give a one-size-fits-all for all these kind of results. What I generally look for is whether they're increasing their revenue. You know, in other words, whether the product they're selling is increasing, and also are they keeping control of costs. So in my mind, that's how I look at a business.
So earnings down could mean they've increased earnings, but their costs have risen.
Yes.
And that interest rate. Okay.
Yes, that could be a bad sign. And with banks, what's happened is they're increasing provisions, you know, and they might be increasing bad debts as well. Or what.
Dave, I wish we had another half an hour to carry on, but you know, you've heard me mention previously that if only investors would think about their equities investments similar to the property. So let me explain to you. Someone buys a property for R1 million, they sell it for 3 million, and they tell you they made a profit of 2 million. Simple. Someone puts R1 million into the market, their portfolio goes to 4 million, but it drops to 3 million. Now they tell you they didn't make 2 million, they told you they lost $1 million. So I always say, why don't investors then understand what was the highest price they could have received out of their property and then assess that they lost money? But it's the characteristics of both investments are exactly the same. So I'll never understand when people do those calculations. You know, most people that put proper investment properties in the balance sheet anyway show it in cash. So very, very puzzling for me, David.
It comes back to your first slide, sentiment.
Yeah. Well, David, thank you for joining me this evening. It's important to note that our program is to provide information and should not be construed as advice. Next week's program, we'll be dealing with estate planning, and you need to get hold of me. My details will appear on the screen. I'd like to thank you for watching, and good night.